an APY boost on Vanguard's Cash Plus account. Plus, what is the outlook for the upcoming week's tips auction? Hello, Diamond NestEgg members, super savers, and course fans. I hope you're healthy and well, and welcome back to our weekly update. And also a big welcome to all our old and new members who've already joined us in our brand new VIP investment club the past few weeks. We've already seen many good discussions and exchanges in our VIP member community. So, short-term treasury yields are considerably lower now than where they were a year ago. But longer-term bond yields have held up better and are still at good levels relative to the averages over the past 2 decades. And one of the questions that continues to be top of mind for many of our Diamond NestEgg regulars here is, should I be opportunistic and stay liquid, or should I lock in longer-term yields before they potentially come down? With that in mind, the first section of today's video is for those of you who may want to stay liquid, but earn a bit more on your cash with Vanguard. And our next 2 standard video sections will be more interesting for those of you who want to lock in longer-term yields, regardless of which broker you're with. Here are the 3 topics I'll be covering today. 1. What is Vanguard's Cash Plus account APY boost, and how does it work? 2. How do current rates compare for treasuries and annuities? And 3. What are the predicted yields for the upcoming week's treasury auctions? Here we'll be speaking about the outlook for the upcoming 10-year TIPS and 20-year T-bond auctions. Let's dive in now, folks. What is Vanguard's Cash Plus account APY boost, and how does it work? Vanguard's Cash Plus account is essentially a cash management account, similar to the cash management account that many of our Fidelity folks here are familiar with. Think of it like a savings account at Vanguard where you can park your uninvested cash while getting FDIC coverage and a rate of 3.35% at the time of this taping. This 3.35% includes a 0.25% APY boost to the base APY through April 30th, 2026, which otherwise stands at 3.1% currently. What this means is that if the base APY of 3.1% moves down anytime between now and April 30th, your APY with a 0.25% boost will move down accordingly. And if your base APY moves up during that period, your APY with a 0.25% boost also moves up. If you already have a Vanguard account, you should have received an email like this one here shortly after the new year, informing you about the APY boost. And if you didn't get the email, all you need to do is open a Vanguard Cash Plus account or transfer money into your existing Vanguard Cash Plus account to get this 3.35% APY. According to Vanguard's website, their cash management account offers the standard features that most of our banking accounts do, such as next-day bank transfers, bill pay, up to $100,000 in daily transactions, mobile check deposits, direct deposit, and compatibility with apps like PayPal and Venmo. It costs $0 to open the account. There is no minimum balance, no account service fees when you sign up for e-delivery, no fees to transfer money between Vanguard accounts, and no fees to transfer money to banks and payment apps through electronic bank transfers and ACH. Although there may be low fees for certain transactions, such as outgoing wire transfers. Now, this 3.35% is part of the bank sweep program in Vanguard's Cash Plus account. And as I mentioned earlier, it is FDIC insured, up to $1.25 million for individual trust and organizational accounts, and $2.5 million for joint accounts. For those of you who may want a bit more yield, you can also choose to put the cash in one of Vanguard's 5 money market funds, which have a $3,000 minimum investment each and are SIPC insured up to $500,000 in total. These 5 are VCTXX, its California Municipal Money Market Fund, VMRXX, its Cash Reserves Federal Money Market Fund Admiral Shares, VMSXX, its Municipal Money Market Fund, VYFXX, its New York Municipal Money Market Fund, and VUSXX, its Treasury Money Market Fund. I know some of our Vanguard folks have a preference for the bank sweep program because of the FDIC protection. But personally, if I had $500,000 or less in my Vanguard Cash Plus account, I would go with VMRXX or VUSXX. Both funds show a 3.65% 7-day SEC yield at the time of this taping, which is more than the bank sweep program of 3.35%, even with a temporary APY boost. And for those of you in a higher tax bracket in New York or California, VCTXX or VYFXX might be attractive options as well, if you can get comfortable with a muni money market fund. There are a few things to note about Vanguard's Cash Plus account, with the most notable one being that it does not offer check writing or an ATM card. Now, we as a family could probably live without check writing, but not having an ATM card is a no-go for us for a cash management account. Your situation, however, may be different. In any case, Vanguard will give you a routing and account number so you can pay bills, set up direct deposit with your employer, etc. But they also warn that some third-party institutions may not accept the Cash Plus account routing number for transactions. In addition, Vanguard highlights that your transactions may be subject to a 7-day holding period, and that generally new accounts will be subject to a 60-day holding period for cash and check deposits. Feel free to pause and read through this if you want further details. I've linked everything below this video for your convenience. We don't have a Cash Plus account with Vanguard simply because we don't have enough cash with them for it to be worthwhile opening another account. But for those of you with Vanguard, drop a comment below and let us know, do you have a Cash Plus account? And if you do, how happy or unhappy are you with it and why? Also, do you park the cash that's in there in the bank sweep program or in their money market funds? And for those of you who are with Fidelity, drop a comment below if you would like us to do a similar review of their cash management account. So, now that we've talked a bit about the cash that we want to keep liquid, let's move on to the next part of our discussion for those of you who may be interested in locking in at the current still attractive rates for a bit longer. How do current rates compare for treasuries and annuities? As we normally do at the end of the week, let's compare the annuity and treasury rates at the time of this taping. For this comparison, we'll focus specifically on rates for multi-year guaranteed annuities, MYGAs, from a AA+ rated insurance company that we work with. AA+ is the best credit rating that an insurance company can get from AM Best, which is a ratings agency that specializes in the insurance industry, meaning the lowest risk, making the MYGA rates that we're about to cover most comparable to treasuries in terms of risk-return profile. And remember that MYGAs work essentially like a CD, similar to a bond, except that MYGAs do not pay interest regularly, but accumulate it in the MYGA account and pay out everything together at maturity. So let's begin with some sample rates for MYGAs. Here you have the investment amount for each investment range, from $10,000 all the way up to just under $10 million. And here's the rate for a 2-year MYGA, 3-year MYGA, and so on, all the way up to 7 years. For example, if you were to purchase a $10,000 7-year MYGA at the time of this taping from this AA+ carrier, your rate might be 4.35%. A $50,000 7-year MYGA might earn you 4.45%. A $100,000 7-year MYGA might earn you 4.6%. And a $1 million MYGA might earn you even 4.65% for 7 years. So basically 15 basis points higher than last week for everything longer than 2 years. And if you have more than the amount shown here, say north of $10 million, your rate might go as high as 4.75% with this AA+ insurance carrier this coming week. Remember that because annuity rates track interest rates, this means that annuity rates, like interest rates, are still at above average levels when you compare them over the most recent 20-year period, despite short-term rates having come down in recent months. Do keep in mind that the MYGA rates in this table are subject to change at any time without prior notice, and that your personal rate may be higher or lower depending on a number of factors. The factors that may influence your personal rate may include how strongly or not so strongly the insurance company you're buying your annuity from is rated, meaning how risky or not risky your insurance company is. As a general rule of thumb, though, and all else being equal, the higher the rate, the lower the credit rating of the insurance company, similar to bonds. Your personal rate will also depend on your investment amount, your annuity type and term, your state of residence, and other specific circumstances. Your personal rate is not fixed before you sign your annuity contract. Now, Let's move on to Treasuries. There's usually a $1,000 minimum for Treasury transactions with most leading brokers, like Fidelity, Schwab, and Vanguard. Treasuries are more liquid than MYGAs because you can sell them before maturity on the secondary market at whatever the then prevailing market price may be. Do note that MYGAs usually only allow you to withdraw some part of your capital per year without penalty, for example, 10%. This liquidity advantage of Treasuries over MYGAs is also one of the main reasons why Treasury rates are normally lower than MYGA rates. As this table shows, the rates on Treasuries range from as low as 3.59% for a 2-year term up to 4.02% for a 7-year term. This is the first time in a long time that the 7-year Treasury is paying above 4%. And like last week, what we see here is that for a 2-year term and for amounts under $100,000, you're now a bit better off with the Treasury than a MYGA with this top-rated insurance carrier. For a 2-year term with amounts $100,000 plus, and for anything longer than 2 years, the MYGA rates continue to win over Treasuries, and more substantially so the further out you go and the more you invest. So, if you're comfortable with the illiquidity of MYGAs, their lack of regular interest payments, and the possible early withdrawal penalties before the term ends, or before you turn 59 and a half, and you want to lock in these MYGA rates for the long run, or if you're considering an annuity for the principal protection and guaranteed lifetime income that they can offer, now may be a good time to reach out to a trusted annuity specialist. Annuities come in many different flavors. As I explained earlier, MYGAs, multi-year guaranteed annuities, work essentially like a CD, similar to a bond, except that they do not pay interest regularly, but accumulate it in the MYGA account and pay out everything together at maturity. Whereas FIAs, fixed indexed annuities, allow for potentially higher market-based returns tied to the S&P 500, for example. FIAs come with full principal protection, but also with an upside cap, and might be something to consider if you want to stay in the stock market for the higher returns, but are concerned that we're headed towards a market correction, as we discussed in these 2 recent videos on how to protect your money against a bubble, linked below in the first pinned comment. The first-year cap on a 7-year FIA for amounts $100,000 plus still stands at an attractive 9.25% at the time of this taping. For a 7-year cap that stays the same for the life of the FIA, that number also continues to be worth a look at 7.25%. There are also SPIAs, single premium immediate annuities, which can offer an immediate stream of lifetime income and fixed payments, and QLEX, qualified longevity annuity contracts, which are generally used to lower required minimum distributions, RMDs, defer taxes, and manage longevity risk if you have pre-tax retirement savings. You can check out these annuity videos here, all linked below this video, if you want a deeper dive into who should buy a MYGA, some other type of annuity, or no annuity at all. Or shoot us an email at jennifer@diamondnestegg.com so that we can connect you with our trusted annuity specialist to see what your options may be, because there's no cookie cutter, one-size-fits-all annuity solution. Any annuity you purchase should be customized to your individual circumstances, goals, and expectations, and fit properly in your overall portfolio, regardless of size. Moving on now to a usual table with Treasury yields from this past Friday versus the previous week, across all the maturities that the Treasury issues at auction. This last row here shows the increase or decrease in rates over the past week. Increases in rates are shown in black. For the first time in quite a while, our weekly comparison chart is all green, meaning yields are up across the board from a week earlier. And interestingly enough, it's again the yields in the middle that are up the most. These 7 and 8 basis points here for the 3, 5, and 7 year, the maturities where we have been seeing a yield dip for much of the year. As we always say, the markets don't tell you directly why they're doing what they're doing. So there are 2 ways of reading this table. The optimistic take is that the yield curve continues to normalize. We're not fully there yet, but as I just mentioned, the yield dip in the middle is getting steadily shallower, so to speak. And we're inching closer again to the normal state of affairs, where the longer you tie up your money, the higher the yield you'll get. A normal yield curve is usually interpreted as a bullish sign that the market expects economic growth and maybe a bit of inflation, while an inverted yield curve is taken as a warning sign that the markets are expecting, or at least fearing, that a recession may be around the corner. And for the super savers in our community who are ready to invest further out, these higher yields may be good news as well. On the flip side, the less optimistic take, if you will, is that the higher yields across the board can also be interpreted as a warning sign the market doesn't like the recent threat of criminal prosecution against Fed Chairman Powell and is pricing in potentially higher inflation if a weakened Fed starts lowering rates faster and further than they would otherwise. We don't have a crystal ball here at Diamond NestEgg, but we strongly suspect it's a mixture of the two. Equity markets have remained close to all-time highs over the past few weeks as well. So maybe what we should prepare for is indeed a higher growth, higher inflation scenario. Only time will tell. Now, let's take a look at Treasury yields from this past Friday versus a year ago on January 2nd, 2025. As before, this last row here shows the increase or decrease in rates since the beginning of 2025. And again, increases in rates are shown in black and decreases in rates are shown in red. This chart shows the color scheme that we've almost gotten used to by now. With the single exception of the 30-year Treasury, yields are down across the board since the beginning of last year. And the shorter the maturity, the further down they've come. Again, reinforcing the fact that the yield curve has been steepening and normalizing. And with this past week's slight uptick, yields, especially at the long end, remain quite attractive if we compare them to the average yields over the past 2 decades, at least for the time being. The next major checkpoint for how it will develop will be the next Fed meeting on January 30th and 31st. And maybe a Supreme Court decision on whether the International Emergency Economic Powers Act, the IEEPA, was sufficient to give President Trump the authority to impose his Liberation Day tariffs. Stay tuned for more on that as the situation evolves. Keep in mind that these numbers give you a general feeling for where rates currently stand along the maturity spectrum. The yields that you may get when you buy at a specific auction or from a specific broker, or when you sell, will likely differ a little bit from what's shown here. You can find more details on these Treasury rates for any day of the week that the bond market is open on the Treasury's daily Treasury par yield curve rates page. All sources are linked below in the first pinned comment. So, now that we have a good overview of where Treasury and annuity rates ended this past week, let's move on to the next part for today. What are the predicted yields for the upcoming week's Treasury auctions? If we go to Treasury Direct's upcoming auctions page, we can see that the 13, 26, 6, 17, 4, and 8-week T-bill auctions are happening as usual. The 52-week T-bill will also be auctioned off this coming week. And if we scroll down, we can see that the 20-year T-bond and the 10-year TIPS are also on the schedule this coming week. The 20-year T-bond is a reopening auction, so we already know the coupon on that. At the time of this taping on Fidelity's platform, here's where the expected yields stand for the T-bills that have been announced already. The 6-week at 3.632, the 13-week at 3.624, the 26-week at 3.613, and the 52-week at 3.534. For the 20-year T-bond, the coupon is 4.625, and the expected yield is 4.789. For the 10-year TIPS, the expected coupon is 1.75, and the expected yield is 1.842, which is a bit lower than the average real yield of 1.95% over the past 12 months, but still higher than the 5-year average real yield of 0.65%, and more than double the current I-bond fixed rate of 0.9%. So, if you're comfortable with TIPS, this may be something to take a closer look at. Remember, though, that whereas I-bonds are pretty much straightforward, TIPS, like annuities, can get complex and fast, especially if you need or have to sell those TIPS before maturity. That said, for the right investor who's willing to invest a bit of time to understand them, they may be worth the effort, as they both offer something that's not easily available from other investments. Bond beginners, folks, please refer back to these 2 modules here on TIPS and I-bonds for a refresher. Also, the break-even inflation rate on the 10-year TIPS was 2.33% at the close of market on Friday, which is just a tiny bit lower than the average break-even inflation rate over the past 5 years of 2.36%. As a reminder, the latest inflation report from the BLS, the U.S. Bureau of Labor Statistics, showed annual inflation coming in at 2.7% overall at the end of December, and core inflation coming in at 2.6%. So, if the 10-year TIPS fits your timeline, goals, and expectations, you want to add some inflation protection because you believe that inflation over the next 10 years will average more than 2.33% annually, and you're comfortable with the complexity, overall lower liquidity, and tax nuances of TIPS, then this may be an auction to consider dollar cost averaging into. Please also keep in mind that all of these numbers can and usually do change all the way up to the time of the auction. And if you're interested in continuing the conversations with me, Marcus, and our Diamond NestEgg VIP members on the upcoming week's auctions, or just other safe ways to generate additional income in 2026 beyond what treasuries and annuities can pay, either via corporate bonds, high-yielding bond funds, covered call strategies, preferred shares, and other investment vehicles, I'd like to invite you to come join our private VIP investment club, where we will be having our very first VIP member live this coming Sunday, January 18th at 5 p.m. Eastern Time, 2 p.m. Pacific Time. Remember, our Diamond NestEgg VIP investment club is the ideal place for you if you want to, 1, have an extra pair of eyes for critical investing questions. 2, get ready for the retirement decisions that lie ahead for yourself or a loved one. 3, understand how a product works, its benefits, and its risks. 4, be the first to know about safe and or higher yielding investments. 5, spot and clearly understand new market trends and issues. 6, exchange perspectives with a like-minded community. And or 7, continue your lifelong learning about investing and retirement. If you fall into one, some, or all of these categories, visit our website at www.diamondnestegg.com and click on this yellow Private VIP Investment Club button to learn more. All right, members, super savers, and course fans, I hope you enjoyed today's video and learned something new. And see you again very soon with more brand new wealth building content for your financial journey.